All right, so we're pointing out some of the headwinds right now with this, the Fed Beige Book talking about rising prices, slowing hiring. Inflation continues to be a concern for a lot of people. And right now you say you're looking for opportunities in consumer-facing platforms, companies like a Shopify or a Lemonade. Do you have confidence the consumer can get through all these headwinds? I mean, what makes you so confident in these specifically consumer-facing platforms as opposed to companies that depend on business spend?
Yeah, you're exactly right. And because of the volatility that you framed very nicely at the beginning of the show that we've experienced in the markets in the last 3 months, it's really produced opportunities in companies that have unified software platforms that are facing the consumer that are, AI first. And what I mean by that is companies that have great distribution footprints, they have very locked in consumers because they deliver great products, and then they're able to automate to reduce their cost curves going forward. So the market has moved into companies like Netflix, Spotify, Uber. These are well-known consumer-facing platforms that have delivered these types of outcomes for investors. But there is a number of companies underneath that with a lower market capitalization, like Affirm, like Shopify, like Lemonade, that are delivering exactly the same types of execution in the market, but are not being rewarded in the market as we see today.
But Storm, you got to explain the thesis. I mean, while AI may help them be more efficient or maybe roll out new products, what about a consumer that doesn't have the money to spend if we're talking about rising prices through inflation or slowing hiring? I mean, if people don't have jobs or they don't feel confident about their jobs, they don't spend.
Yeah, so what we learned during COVID is that if you are focused on driving value for customers by driving the prices down, then what you have is in a more difficult economy is that customers or consumers move towards those products where they're innovating and driving prices lower. So that's where companies like Affirm, like Lemonade really benefit because they're focused on driving value for customers, and that's by driving prices lower. So if it is a more difficult economy going forward, then we expect customers to move to these platforms because they just deliver a better product.
Later on the show, we're going to go to one of the wealthiest investment conferences in the world. A big part of the conversations there is about alternatives, whether it's private equity or private credit. You're really liking two alternative asset managers that they've bounced from their April 8th lows, but they're still about 30% from their 52-week highs. That's Apollo and Blackstone. What's the catalyst? What do you think gets them back to those all-time highs?
Yeah, so the long-term structural case for these companies is really exceptional. We need significant infrastructure build out, both in compute and the data center, also in transportation as we electrify, and also in power supply. So we know over the next 10 years, a significant amount of capital needs to be spent to build out these assets. Apollo and Blackstone are going to be the companies that enable this build out. What we've had a significant pullback in the last 3 months from a stock price perspective, which has given us the ability to make investments in these particular companies. And then what we know is that capital markets over the next 6-12 months will eventually open up. Obviously, the trade policy and physical policy uncertainty has slowed that opening up. But as we go through into the second half of this year and into the following year, we expect these companies to be able to exit a number of investments they've made in the last decade as well.
Yeah, but in all fairness, if the capital markets open up, the IPOs, start flowing, how does that help these alternative asset managers? A big part of not a big, but a growing part of their business is private credit. When things start to loosen up and there's more liquidity, doesn't that hurt one revenue stream for them? And also, everything you mentioned's already publicly known. Why isn't that already priced into the stocks?
So these are very volatile stocks because of the types of investments that they make. But these, over the last 10 years, they've compounded shareholder returns at about 20% per year. They provide services into the financial service industry, which banks can no longer do, so due to regulation. And so they are benefiting from very strong structural growth over the next 10 years because of these very large infrastructure requirements. We use market volatility to build positions in these types of companies where we think that short-term market inefficiency exists, but over the longer term, these companies will get rewarded for what they're able to obtain.